All right, so the question is, Mark, aren't you being a little blasé about recessions and the economic problems that people are having when I talk about the crypto market? And, look, I understand it's valid where you're coming from. Don't mean to downplay the potential for recession or some sort of other major event. If you follow me for long enough, I've been talking since the end of 2021 when the U.S. economy went into reached full employment. I told you to look out for a recession because it happens within 5 years of full employment, like clockwork, usually within 3 years. It's more reliable than the yield curve inversion or anything else that people are talking about. And technically speaking, the US economy had a recession in 2022. The only reason they don't call it a recession is because during the Trump administration, the government decided, hey, we're not going to have any definitions of recession anymore. It's going to be whatever we want it to be. If the economy does bad enough on enough levels for long enough, we'll call it a recession. Unless we decide we don't want to call it a recession, then we won't. That's literally the policy. You can look it up. I've talked about that at length. But in 2022, U.S. economy went through 2 quarters of negative growth. You saw the stock market was obliterated. A lot of problems, a lot of stress, a lot of fuss. Massive inflation, the whole deal. That was 2022. Now we're in 2023. Look, we'll see. We'll just have to see how things go. The thing I want to stress is you don't know how things are going to play out. And to the other point, which is, rising rates, higher for longer. They're going to keep raising rates. They're going to crush everything. Stock market, crypto. Nothing can go up unless the Federal Reserve has low interest rates and quantitative easing. Think about it this way. While, higher rates is tough for anybody who depends on credit, if you have cash, you're great. The return on cash has gone up over 1,000% in just a year and a half. 1,000%. It's gone up. The value of having cash has gone up 1,000% because interest rates have gone up. So now if you have cash, you can give it to the government. You can get more from, if you have a fixed rate loan of any kind, commercial, residential, anything, fixed rate loan, lower than 5%, you are actually disincentivized from paying that off. If you have $100,000, for example, you give it to the U.S. government, you get 5% per year annualized. You could lock it up for 1 year, 5% annualized. Go and get a 0 interest credit card, which you can still get. Lots of people. If you have decent credit, you can still get 0 interest credit card. 12 months. They allow you to borrow money at no cost. $100,000 with the U.S. government gets you back $5,000 over that time. Run up a $20,000 credit card bill. Pay it off. $5,000 of free money goes to paying it off. So now you only owe $15,000 on that credit card bill. And you have $100,000 in reserve that you can now use to pay that off. So, the normal person doesn't think about these things, but a lot of businesses that are in the same kind of situation where it's like a carry trade. It's almost like the equivalent of a carry trade. But even if they don't do that, they're making money off of having money for the first time in some of these businesses ever. That's how long it's been since you could do that. So you look at something like Coinbase, $5 billion. Well, now they're like $4 billion in cash. Last year they had $5 billion in cash. Now they have $4 billion in cash. Last year and a half ago, raging bull market, rates at 0. They got $5 billion sitting in the bank. It makes like barely anything, maybe $50 million, $25 million, $50 million, something like that on that $5 billion. $4 billion, fine, it's more like 40 million or 22 million, whatever it comes out to be. Now they put $4 billion, give $4 billion to the federal government or any other interest-bearing financial product that comes close to the yields that you get on T-bills or even 1-year treasuries now. And now those $4 billion are bringing back $400 million, $200 million cash. It's like $200 million just fell out of the sky simply because Coinbase was judicious in its spending. It cut staff, it cut costs, it raised a lot of cash, and now it has a lot of cash. And there are a lot of businesses that are in that situation. You talk about commercial real estate. Yeah, it sucks. Over the next 3 years, 2-3 years, there are a lot of loans that are going to come due that they can't refinance because the property has lost so much value and the business is not profitable enough to cover the expense. And that's going to suck for banks. A lot of smaller banks, they're heavily involved in commercial real estate and commercial real estate development loans. They're going to get crushed. It's going to be really hard. But also, they've had years to prepare. And there are people flush with cash who are just waiting. They're circling like vultures, waiting for those distressed sales so they can buy them up. And and you know that there are loan officers and people who work for the banks. There are people who work for the development companies. There are people who work for other entities that are looking to acquire properties or acquire companies. They're already talking about how they're going to fix this, how they're going to work this stuff out. And so they come to an arrangement. Everybody gets a little haircut. The people want to the people want to buy distressed properties. Maybe they don't get quite as good a deal, but they get the assurance of knowing that they can take over the property. The developer still loses money, not as much as they would have lost before, and the bank is able to turn over that loan to somebody else. They take a haircut too, but things work out, and they're doing this because it's better if everybody takes a little haircut than nobody gets what they want. And there are all sorts of other things where you don't know specifically how that's going to play out and to what extent, but you know it's happening. And how do you account for that? You can't. And the data can't account for that. Unemployment data too. I mean, we don't even know if that's being calculated properly. I don't know how the gig economy is being accounted for. What about people who have side gigs, who have internet businesses on the side? People who have a day job and write a newsletter, for example, like me. Like if somebody called me and said, "Are you employed?" I'd say yes, but I have 2 jobs. I have double the income that you would have expected from somebody who just had 1 job. So like, is that accounted for? I don't know. Every data source accounts for these things differently. They calculate differently. And then you have to decide whether or not you want to project these trends out into the future or just accept what they are today. What do you do? Another thing, demographics. People talk terrible demographics. Well, if you include immigration, U.S. demographics look great. If you exclude immigration, U.S. demographics look bad. Immigration has been going down over the years. Legal immigration. Illegal immigration is a totally different issue. People are trying to get in, but if you're just being like, sorry, I don't want to go there. I know that inflames people's attention, but the point is, if you choose to assume that immigration patterns will go back to the way they were just a few years ago, legal immigration, or even illegal, just people coming into the country and staying, U.S. is going to get healthier, younger, and more productive, because that's when you include that's what you get when you include the immigration data. Sorry, it's a fact. Whether you like or disapprove, whether you approve or disapprove of immigration, it is just what you have seen. And then if you exclude immigrants, then yeah, we're getting older, we're getting sicker, and less productive. Well, what do you choose? If you look at the forward-leading indicators, some of these look terrible. But if you look at the benchmarks, the historical benchmarks, they look fine. In some cases, they're very healthy. They're still below trend in terms of credit utilization as a percentage of GDP. And even with credit utilization, it doesn't differentiate between people who have a HELOC, well, I shouldn't say that, but a fixed mortgage, a 30-year fixed mortgage at 3%, who could, or if they wanted to, they have the means to pay down that mortgage early, but they're getting 5% from the government or 5% in a money market mutual fund. So they're not. You add that to people who opened up credit cards at 0% for 12 months, 18 months, doing what I said at the beginning of this video. And then how are people using that debt? Is it all commercial debt? Yeah. Is it all retail debt? People buying and consuming. Well, people are getting pay raises. Wages are going up. We know that. That's a fact. Wages are going up. Job openings are still really strong. So how do you account for that? So there's just so much complexity. We know recession is going to come. We know things are going to get bad. We don't know when. So why stress about it? Why pay for it? Prepare for it. Prepare for it by making sure that you know what will happen if you lose your job, by making sure you have cash or reserves that you can bank on that are denominated in your government's money. Also make sure you have an allocation to cryptocurrency. Make it, and you can make it as easy as that. Crypto is, in my newsletter, Crypto is Easy. Make it that easy. Cash and crypto. And then you don't have to worry about bonds. You don't have to worry about stock market. You don't have to worry about real estate or anything like that. If things go well, you're covered. If things don't go well, you're covered. I'm not saying to do that. I'm just saying if that's a concern, it may be something to think about. The thing you don't want to think about is exactly what month or quarter the recession is going to start and when the market's going to turn over. It's possible we already had the recession in 2022 that everybody was calling for. And it's already done. It's possible that doesn't matter because you can have a recession in 2022 and also have a recession in 2024. So don't worry about it. Accept it. Understand that that's the situation and do what you think is best. Relax and enjoy the ride.